US consumers are in a spendy mood, which backs the Fed chair's caution on rate cuts. New Zealand consumers are a bit more confident about their current finances, but not so confident about future house prices. That's coming up in our 5 Things in 5 Minutes on Monday, September the 29th. And then in our deep dive interview, ANZ Head of FX Strategy Mahjabeen Zaman explains how Aussie pension funds dealt with an apparent breakdown earlier this year in the traditional link between the Aussie dollar and global risk assets.
If this breakdown continues to remain, and if the Aussie dollar provides lesser of a natural hedge to these superannuation funds, then maybe they might look to increase their hedge ratios.
But first, in 5 and 5 with ANZ, US stocks closed slightly higher and US bond yields were largely unchanged on Friday night after US personal consumption expenditure data, which is the Fed's preferred measure, showed core inflation was 0.2% in the month of July and 2.9% from a year ago. That's unchanged. However, ANZ senior rate strategist Jack Chambers says the Fed will have noticed robust consumer spending in those figures.
Some of the concerns that may have been there about re-accelerating inflation have diminished a little bit. What was maybe more interesting in the numbers was the spending. Consumption actually improved, and we've had 3 months in a row now, the last 3 months, of pretty strong consumption growth. So after a little dip initially after the tariff announcements in April and May, spending since then has picked up. And that's kind of consistent with what we saw in the revisions to the Q2 GDP data, which were revised higher with consumer spending higher.
The S&P 500 and the Nasdaq closed up 0.6% and 0.4% on Friday night. The US 10-year Treasury yield rose 0.7 basis points to 4.181%. Gold rose 0.5% to $3,766 US an ounce. West Texas oil futures rose 1.1% to $65.72 US a barrel after Ukrainian drone strikes on Russian oil refineries. The US dollar index fell 0.4%. As of 4 a.m. Sydney Melbourne time, the Aussie dollar was up 0.1% at 65.46 US cents, and the Kiwi up 0.1% at 57.73 US cents. Number 2. Jack says that robust consumer spending ties in with cautionary comments last week by Fed Chair Jerome Powell about the inflationary risks still hanging around. He says that creates some tension with market expectations, which are still that the Fed can cut at least 4 more times in the current cycle.
What I think it could do is maybe not push inflation higher, but prevent a disinflationary trend. Keep inflation in that sort of 3%-ish or 2.5% to 3% range where it's kind of been stuck for the last year or so, which creates a bit of a dilemma for the Fed. What do they do in response to that? Slightly above target inflation, if they're still concerned about a slowing labour market. It just means it makes their job or the ability to calibrate policy a bit more difficult.
Number 3, markets will be focused this week on US non-farm payrolls data for September. That's due on Friday night, with markets expecting jobs growth of around 43,000 for the month and an unchanged unemployment rate at 4.3%. Here's Jack previewing those numbers and what they mean for the Fed's outlook.
It's incredibly important. I think this will go a long way to determining the confidence of markets pricing and easing at the next few meetings. We still expect 4 more cuts from the Fed, 125-point cut at each of the next 4 meetings. Markets are currently pricing in a slightly slower pace of easing from here. There's a bit of uncertainty with this data. We've had soft prints the last 2 times. We've had some downward revisions based on just the natural flow of how the payrolls report is revised over time. There's also a question of if the government shutdown occurs, whether the data will be printed at all.
Number 4. The ANZ Roy Morgan survey of consumer confidence in New Zealand in September showed a slight improvement overall, although readings taken from around 6% of respondents in the days after surprisingly weak GDP data showed a bigger drop. ANZ's chief economist in New Zealand, Sharon Zollner, also notes an improvement in consumer perceptions about their current financial situation versus what they see in their future.
The fact that people are feeling better about their situations today is actually consistent with declining consumer arrears that are being reported by the ratings agencies recently. So although the economy might not be going so well at the moment, it's not the case that households are spiralling downwards and that things are getting worse and worse. Actually, under the hood, things are getting better.
Number 5. Sharon also pointed out, however, that expectations about annual house price inflation dropped from 3% to 2.5% in the month.
That's the lowest in a bit more than a year. And the housing market does have a big impact on how households are feeling. Not everybody owns a house, of course, but a lot of household wealth is in housing. So as long as the housing market's going nowhere fast, that does put a bit of a lid on growth. However, the Reserve Bank has cut rates a lot. The market's now punting that they could even cut more than they indicated in August. And there are other supports such as excellent agricultural prices. We are anticipating the economy will not exactly storm away, but will certainly recover. That Q2 was the bottom, and that from here on things will improve.
Sharon Zollner there. Now, in a deep dive interview, ANZ Head of FX Research, Mahjabeen Zaman, explains why the Aussie dollar's previous correlation with global risk assets was important for Aussie fund managers. That risk-on connection often meant the Aussie dollar rallied when US stocks jumped. That link broke down earlier this year. Here's Mahjabeen to explain how that works and how that connection may now be returning.
Post-pandemic, we have seen superannuation funds reducing their hedge ratio to their international equities exposure from, let's say, about 30% to around low 20%. And, this adjustment of having low hedge ratios is really because the Aussie dollar, they would be selling the Aussie dollar to invest in the US and elsewhere, and taking that short position would provide a natural hedge to risk assets. So if equities overseas fell in value and the holdings fell in value, that would be offset by their short position in the Aussie dollar, which would also fall, which actually would become in the money in a risk-off scenario, if that makes sense. So that's a natural hedge. Aussie dollar tends to provide a natural hedge, and as a result, they shifted to lower hedge ratios and kept their position unhedged. But now, of course, what we have seen in the Q2 superannuation data is that the hedge ratios have just increased from roughly around 21 to slightly above 22% or so. Look, if they were to continue increasing their hedge ratios in a big way, it would then at the margin mean that they'd be selling more US dollars and buying more Aussie. Would that meaningfully impact the Aussie dollar? Well, look, I think, the amount outstanding there for offshore equity exposure is around about 800 to 900 billion. Increasing hedge ratios by a small margin like we've seen over Q1 and Q2 will not meaningfully shift the Aussie, because Aussie is one of the most liquid currencies in the world.
Why do you think they have increased that ratio in the last couple of quarters? Because you're right, it's quite a substantial move down from just before COVID. What do you think's changed their minds?
Yeah, look, I think they have been at extremely low levels, and I think it's also a function of the Aussie dollar and the properties it displays. Now, traditionally, Aussie dollar tends to shift with risk assets, and it displays cyclical properties. But really going back to the fact that we have seen, at least for the first half of this year, its traditional correlation to risk assets, or that its beta to risk assets, it's much lower than it has been historically. And so the offset that it provides as a natural hedge may no longer have been there for at least the first half of the year, because there was a correlation breakdown across FX markets. So if this breakdown continues to remain, and if the Aussie dollar provides lesser of a natural hedge to these superannuation funds, then maybe they might look to increase their hedge ratios.
Does it reflect an underlying unease with the relatively high valuations of overseas assets, particularly US assets, and the extra volatility we've seen in policy since the election of Donald Trump?
Yes, I think it's more really a US dollar story. So having the right view around the US dollar. Now, over the past many cycles, we have seen, if there is a recession, it's a global recession. So even in a recessionary environment, the US has been able to do better than other economies, because over the last 2 decades, they have been very aggressive on fiscal policy, and that's come in tandem with very low interest rates. But having said that, this time around, what we have seen, at least in 2025 with the new administration, is that the concerns are isolated in the US. So there is US policy uncertainty, but it's affecting every other country, of course, one way or the other. But I think it's really much more focused on the US this time around. So that's why we have seen the US dollar be impacted in a much more substantial way vis-a-vis other currencies or economies, which are now more aggressive on fiscal story and more aggressive on monetary policy. And I think that's really what's played out in breakdown of correlations as well.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, September the 29th. Catch you with a preview of the Reserve Bank of Australia's cash rate decision tomorrow, with markets now seeing it being held. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.